So imagine you're looking at a publicly traded company's balance sheet, right? You see this absolutely pristine debt profile.
Yeah, it looks totally healthy on paper.
Exactly, and you decide to invest your life savings based on that, only to find out maybe months later that they secretly owe millions to a commercial bank.
Right, and they're teetering on the edge of a severe liquidity crisis.
And the crazy part is the debt was always there, mathematically speaking.
It was just actively hidden through a few highly technical, seemingly innocuous clauses buried deep in a note on trade receivables.
Which is terrifying for a retail investor. Welcome to a brand new deep dive on the Gap Advisors Ind AS Clinic podcast.
Thanks for having me back. This is such a critical topic today.
It really is. Today, we're bypassing all those surface-level metrics. Our mission is to take a highly specific, real-world piece of financial reporting, put it under a microscope, and extract the exact forensic mechanisms that can, fundamentally alter how you evaluate a corporate balance sheet.
Because it happens far more often than investors realize. We're dissecting a scenario today where a company attempted to just erase a substantial liability from its books, using a really aggressive interpretation of the accounting standards.
And if you're participating in the stock market, understanding how these illusions are constructed is literally the only way you can protect your capital.
Absolutely. The numbers on the front of the financial statements project complete stability, right? But the underlying legal arrangements completely hollow out the company's actual cash position.
So let's establish exactly why this matters right up front. Because there's this persistent misconception that accounting standards, like Ind AS or Indian GAAP, are purely the domain of auditors, ticking compliance boxes in some back room.
Right. It sounds like boring compliance to most people.
Exactly. But if you are buying shares in a listed company, you aren't just buying a ticker symbol. You're buying a fractional ownership stake in an actual business.
Yeah, and the financial statements represent the sole empirical window you have into the health of that business.
So if a company leverages complex accounting treatments to artificially compress their leverage ratios, they distort the fundamental reality of the asset you're purchasing.
I mean, understanding the mechanics of these standards isn't just about compliance. It is the absolute foundation of financial literacy required to protect your wallet.
Well said. The accounting standards serve as the universal grammar of business. If you lack the vocabulary to read the footnotes, you cannot differentiate between a factual biography of a company's financial health and a highly stylized work of fiction.
And as an investor, you're the one ultimately financing that narrative, so you better know how to read it.
For sure. So to read that narrative accurately today, we need to set the parameters for our analysis. We're operating under a specific technical framework, and establishing these ground rules just ensures we analyze the mechanics properly.
Right. Let's get the housekeeping out of the way.
First, the reporting period for our discussion aligns with the standard Indian financial year. So that begins on the 1st of April and concludes on the 31st of March.
Yep. 1st of April to 31st of March. And second, the functional and presentation currency for this analysis is the Indian rupee, or INR.
Okay, got it.
And in the context of this framework, any currency that is not the functional currency, meaning anything other than INR, is strictly classified as a foreign currency.
That makes sense. And crucially, before we dive in, we must state that the views expressed in this deep dive are the personal views of the author of the observation we're reviewing.
Right. They are absolutely not binding on the audience.
We are examining the forensic mechanics of financial instruments, but we urge you to seek the help of a professional expert before taking or refraining from any action based on this discussion.
Exactly. We provide the analytical framework, but your financial and legal decisions remain your own.
Okay, with that framework established, let's get into the source material we're dissecting today, because this is what makes it so critical.
We were not examining some theoretical textbook problem here.
No, not at all. This observation comes directly from the published Ind AS financial statements of an actual publicly listed company.
And it wasn't flagged by a whistleblower or an internal audit committee or anything like that.
All right, this was downloaded and independently reviewed by Gap Advisors on a suo motu basis.
Which means entirely on their own initiative. Their team regularly scans published reports to just pressure test the application of these standards out in the wild.
And the specific observation we're tearing apart today was actually recently featured in the Gap Advisors Task Weekly newsletter.
Yeah, that's a fantastic resource.
It really is. That newsletter is authored by C.A. Manish C. Iyer, who is the director at Gap Advisors, and it's published directly on LinkedIn.
I think they have published over 240 editions of that newsletter to date.
Wow, 240.
Yeah, it's huge. For anyone operating in the professional finance space space on LinkedIn. Subscribing to it for free is just a highly efficient way to track real-world reporting anomalies as they happen.
Definitely. Highly recommend checking that out. So let's get into the exact mechanics of what CA Managed CIR found. I'm going to read the specific scenario derived directly from the company's notes regarding their trade receivables.
Let's hear it.
Okay, so the note stipulates that the company transferred its trade receivables to a bank. However, the arrangement includes a specific clause. It says, if the bank is unable to recover the funds, the bank will claim the amount back from the company.
Okay, stopping you right there. That's a huge detail.
Right, and it gets better. The company will then recover the amount from the ultimate beneficiaries, adding an additional surcharge.
Wow. Yeah, that phrasing immediately triggers a massive red flag regarding the economic substance of the transaction versus its legal form.
So let me try to visualize the exact B2B mechanics here with an analogy just to make sure I'm following.
Go for it.
It's like, imagine I sell my friend's IOU to you for quick cash, but with a major catch. I tell you, hey, if my friend doesn't pay you, you can come right back and demand the money from me.
Right, you're guaranteeing the payment.
Exactly. And if that happens, I'm going to go track down my friend and make them pay me back with a late fee. If I do that, did I ever really transfer the IOU to you in the first place?
No, you absolutely did not. And to put that into a corporate context, imagine a heavy machinery manufacturer.
Okay, machinery manufacturer.
They build a $2 million turbine and deliver it to a distributor. The distributor has 90-day payment terms. That's the trade receivable.
Right, the classic 90-day wait.
But the manufacturer needs cash this week to make payroll, buy raw steel, whatever. They can't wait 90 days. So they go to a commercial bank and execute a factoring arrangement.
They transfer the $2 million invoice to the bank for an immediate cash advance.
Exactly. Say an advance of $1.9 million. Now, in a clean, non-recourse factoring deal, if that distributor goes bankrupt on day 45, the bank eats the loss.
And the manufacturer keeps the $1.9 million and walks away clean.
That describes a true transfer of risk, which would result in the manufacturer legitimately removing that receivable from their balance sheet. That's true derecognition.
But the clause in our published financial statement fundamentally alters that dynamic.
Completely changes it.
Because the manufacturer is explicitly telling the bank, if the distributor defaults, you have full recourse to come back and demand the cash directly from our corporate treasury.
Yep. And furthermore, if the manufacturer is forced to reimburse the bank, they reserve the right to hunt down the distributor and charge them the original $2 million, plus a hefty late payment surcharge.
Which is wild. If the manufacturer is providing a bulletproof guarantee against default and retaining the right to profit off late penalties, they haven't actually sold the asset at all, right?
Not even a little bit. They have simply pledged it as collateral for a short-term corporate loan.
Wow. Okay, so that deduction drives straight to the core of Ind AS 109, right?
Yeah.
The standard governing financial instruments.
Yes. And to understand why this standard is so uncompromising on this exact issue, we kind of have to briefly look at the historical context.
Like going back to the 2008 financial crisis.
Exactly. If we rewind to 2008, one of the primary catalysts was off-balance sheet financing. Financial institutions were transferring toxic assets, like subprime mortgages, into special-purpose vehicles and legally selling them.
Right, quote-unquote selling them, effectively erasing them from their balance sheets.
But they retained massive amounts of implicit risk. So when the underlying assets defaulted, the risk boomeranged right back onto the originators.
And wiped them out almost overnight because investors had no idea the exposure still existed.
Exactly. So the regulators realized that just looking at a legal bill of sale wasn't enough to protect the financial system. You can't just trust the legal form.
Post-2008, the international accounting community realized that legal form could be easily manipulated to hide leverage.
Which led to the rigorous development of IFRS 9 globally and its Indian equivalent, Ind AS 109.
And we should definitely establish right now for our international listeners, while we are analyzing this under the Ind AS framework, there is absolutely zero difference between Ind AS 109 and IFRS 9 regarding this specific topic.
None whatsoever. The derecognition of financial instruments is handled identically. The mechanics we are discussing apply to any entity globally following the IFRS framework.
That's great to know. The financial physics remain identical whether you are auditing a firm in Mumbai, London, or Sydney.
Right. So under Ind AS 109, the standard demands we look past the legal transfer document and examine the economic substance.
The key test for derecognition, which dictates whether an asset can be legally removed from the books, relies entirely on the transfer of significant risks and rewards of ownership.
And we evaluate that test by looking at the primary exposure. So for a trade receivable, the dominant risk is credit risk.
Basically, the probability that the counterparty defaults.
Exactly. By signing a contract with a full recourse clause, the company explicitly retained 100% of the credit risk.
Because the bank took on essentially zero default risk, their cash advance is guaranteed by the company itself.
Right. And they fail the reward side of the test just as spectacularly.
Oh, yeah, because of the surcharge, right.
Yeah. Yep. The company structured the deal so that if a default triggers their recourse obligation, they get to slap a surcharge on the ultimate beneficiary.
So they retained the right to the economic benefit of the late fees, they kept the downside risk of default, and they kept the upside reward of the penalty margin.
Which means the conclusion under Ind AS 109 is immediate and definitive. The transfer utterly fails the conditions for derecognition.
Wow. So the company is legally prohibited from erasing those trade receivables from their balance sheet. The asset must remain exactly where it was.
It has to stay on the books.
Okay, so since we've established the receivables can't be erased because the risk never left, that leaves a massive glaring hole on the other side of the ledger, doesn't it?
It sure does.
The company didn't sell an asset, but a commercial bank still wired millions of rupees in gross cash into their corporate accounts. We have to address how that cash inflow is mathematically handled if it isn't revenue from a sale.
Well, the mechanics of double-entry bookkeeping demand a corresponding entry. If the cash received cannot be credited against the derecognized asset, the economic reality dictates that the company is engaged in collateralized borrowing.
So the cash received from the bank must be recognized on the balance sheet as a financial liability. It's essentially a loan.
Short-term debt obligation, yes.
Mm-hmm.
The balance sheet should mathematically expand.
Right, so on the asset side, the trade receivables remain intact. On the liability side, a brand new line item appears representing the cash owed to the bank.
That's how it should look. But when JAP advisors scrutinized this published statement, they discovered the company took evasive action.
They bypassed the balance sheet expansion entirely, didn't they?
They absolutely did. The company set off the trade receivables against the financial liability.
Wow.
Yeah, they netted the two figures against each other on the face of the financial statements, effectively making both the asset and the newly acquired bank debt disappear from view.
That is bold. Let's run a stress test on why a CFO might try to justify this maneuver. The argument usually goes something like this, right? The bank provided funds that are inextricably linked on a one-to-one basis to specific customer invoices.
Right, they argue it functions as a closed-loop system.
Exactly. They say when the customer eventually pays the invoice to the bank, the liability is extinguished simultaneously with the receivable. So presenting them as bloated gross numbers on the balance sheet might confuse an investor who thinks the company has more free cash flow or general corporate debt than it actually does.
I've heard that exact argument so many times.
So why does Ind AS 32 forbid netting these amounts? What's the problem with that logic?
The problem is that justification relies on a best-case scenario where no one defaults. It fundamentally misrepresents the legal obligations in a stress event.
Because things go wrong.
Things always go wrong. Ind AS 32 establishes a rigid dual-condition test for when an entity is permitted to set off a financial asset against a financial liability.
And you have to meet both conditions.
You must satisfy both conditions simultaneously, without exception.
Okay, so let's break down those conditions. To offset under Ind AS 32, the first condition requires the entity to currently have a legally enforceable right to set off the recognized amounts.
And this right must be enforceable not just in the normal course of business, but specifically in the event of default, insolvency, or bankruptcy of either party.
Right, and given the mechanics we've discussed, they clearly fail this because the counterparties don't match.
Exactly. The asset, the trade receivable, represents cash owed by the customer to the company.
God, let's talk owes the company.
Right. But the liability represents cash owed by the company to the bank.
They are completely different entities.
You cannot legally extinguish an obligation you owe to a financial institution by simply pointing to money a third-party customer owes you.
That makes perfect sense. They are distinct, legally binding contracts with completely different counterparties.
The bank doesn't care if the distributor hasn't paid the manufacturer yet.
Right. The bank holds a recourse guarantee from the manufacturer, and if a default occurs, they are coming straight for the manufacturer's treasury reserves. There is zero legal right of set-off.
None. and they fail the second condition just as severely.
Which is the intention either to settle on a net basis or to realize the asset and settle the liability simultaneously.
Right. In the event of a customer default, there is no simultaneous settlement. The company must deploy its own gross cash to reimburse the bank and only then attempt to recover the funds from the customer later.
So the timing is completely off. Let's apply some hypothetical math to this just to see exactly how this illegal offsetting manipulates the investor's perspective.
Let's do it. Numbers always help clarify this.
Imagine a company has 100 million INR in total equity, and they currently hold 50 million INR in legitimate, disclosed long-term debt. A retail investor calculates their debt-to-equity ratio at 0.5.
Which is a very healthy, strong, under-leveraged profile.
Right. But behind the scenes, the company has factored 50 million INR of receivables with full recourse.
Okay, so if they follow the standards, they must keep the 50 million in receivables on the asset side and record a new 50 million short-term liability to the bank.
So their total debt is actually 100 million, not 50. Their true debt-to-equity ratio is exactly 1.0.
Which completely changes the risk profile for an institutional investor or a bank calculating debt covenants. That's twice as much leverage.
But by illegally offsetting under Ind AS 32, they wipe that 50 million liability off the presentation entirely. The investor looks at the published report, sees the manipulated 0.5 ratio, and buys the stock.
They are completely unaware that a severe downturn in customer payments could trigger a 50 million INR margin call from the bank that the company doesn't have the cash to cover.
Which is why this isn't just an academic debate about spreadsheet formatting. It is the active concealment of leverage.
It really is. And that brings us to the forensic reality of how these violations are actually caught.
Yeah, how does an auditor or an independent team like Gap Advisors trace this manipulation when the numbers have been netted out and hidden from the face of the balance sheet?
That forensic accounting process is absolutely fascinating. Because if the liability is netted to zero, you can't just look at the debt column and spot the error.
Right, it's just not there. You have to hunt for discrepancies in the cash flow and the footnotes. How does a Gap advisor trace the cash flow from the bank back to the specific receivables if it's not prominently disclosed?
It requires a relentless cross-examination of the notes to the accounts. The forensic process usually starts in the cash flow statement.
What are they looking for there?
You might see a massive influx of cash from operating activities, specifically a sudden, uncharacteristic decrease in trade receivables that doesn't logically align with the company's revenue growth or historical collection days.
So the receivables are seemingly being collected incredibly fast, generating a ton of cash.
Right. And that prompts the auditor to dig into the specific footnote disclosures regarding borrowings and financial instruments.
Even if a company illegally offsets the numbers on the balance sheet, they often leave a trail in the qualitative disclosures.
Always. An auditor will look for the exact verbiage we analyze today. Words like recourse, surcharge, or guarantee buried in the fine print detailing their banking arrangements or factoring facilities.
So they cross-reference the rapid cash collection against the disclosure of a banking facility that mentions recourse.
Precisely. Once you locate the recourse clause, you know the risk wasn't transferred. Then you look back at the balance sheet. If the short-term borrowing line item hasn't increased proportionately with the factored receivables, you have mathematically proven the illegal offset.
Boom! Caught them. But this highlights the immense burden placed on the auditors and the finance controllers signing off on these documents, doesn't it?
It's a massive burden. The standards run thousands of pages deep.
And if an auditor flags this exact recourse issue during an audit, they have to mathematically prove their interpretation of Ind AS 109 and Ind AS 32 against a CFO who is heavily incentivized to keep that debt hidden.
They need unassailable documentation to back up their challenge. You can't just say, I think this is wrong. You have to prove it.
That requirement for definitive, documented interpretation is exactly why the professional infrastructure around these standards is so critical. For auditors facing these forensic challenges, having access to a comprehensive issue repository is absolutely essential.
And that is why the platform built at derecognition.com has become such a central tool for the industry.
The scale of that repository is staggering. We are talking about a database that currently hosts over 4,500 distinct, highly technical issues and their corresponding responses.
Covering both Ind AS and Indian GAAP, it acts as an active, searchable precedent library.
So if an auditor encounters a highly complex factoring arrangement with a convoluted surcharge clause like we saw today,
the probability is incredibly high that a mathematically identical scenario has already been analyzed cited against the exact paragraphs of the standard, and resolved within that repository.
That's amazing. And the practical application of the tool is designed specifically for the workflow of an auditor.
Yeah, any professional can register on gabbardvisors.com for free.
And it isn't just a static archive you have to blindly search through. You can submit your specific, nuanced issues regarding Ind AS and Indian GAAP directly through the platform.
The mechanism of delivery is what makes it an indispensable audit tool. When you submit a complex scenario, a detailed, technically sound response is delivered directly to the inbox of the email you registered with.
Wow, direct to your inbox. So if you are an auditor preparing working papers, that direct response gives you the exact documentation you need to demonstrate how you rigorously addressed a highly complex application of Ind AS.
It builds the audit trail required to defend your professional judgment when you force a company to unwind an illegal offset and expose their hidden debt.
It provides the empirical backing to stand your ground against aggressive management interpretations.
Exactly. But ideally, we want to prevent these violations from ever reaching the audit stage or the public domain.
Right, which transitions us from forensic detection to proactive structural solutions. Because the reality is, the observation we dissected today was found suo motu by GAAP advisors in a published financial statement.
The illegal offsetting was already out in the wild.
The reputational damage, the regulatory exposure, and the deception of the investors were already locked in.
For a CFO or a finance controller, discovering a fundamental violation of Ind AS 32 after the annual report has been published to the stock exchanges is the ultimate nightmare scenario.
Oh, I can only imagine. Regulators will demand restatements, analysts will decimate the company's credibility, and investors will flee because the trust in the financial narrative is broken.
The defensive maneuver against that scenario is the pre-signing review. Before the ink dries, before the PDF is uploaded to the exchange, preparers and auditors have the ability to submit their near-to-publishing financial statements directly to GAAP advisors.
So they act as the final rigorous stress test against the standards.
Yes. By emailing those statements to info@gapadvisors.com, the GAAP Advisors team can execute a comprehensive review of the presentation, the footnote disclosures, and the application of complex standards like financial instrument derecognition.
So they catch the illegal netting of a recourse liability before it ever becomes a public regulatory crisis.
It's an incredible safety net.
So for the finance teams listening, that email info@gapadvisors.com is your fail-safe. But we also know that financial engineering doesn't stop at basic factoring. Companies are constantly structuring entirely new, highly bespoke financial instruments.
Oh yeah, securitizations, derivative hedges, all sorts of crazy stuff.
When you are designing a complex transaction from scratch, simply reading a standard or a past response might not provide the exact architectural blueprint you need.
In those highly specialized structuring scenarios, the nuances of risk transfer under Ind AS or IFRS require a dynamic, real-time consultation.
You need to map out the cash flows and the legal clauses with someone who understands the absolute limits of the standards.
And that level of direct access is actually available to the listeners of this deep dive.
Yes. If you are dealing with an incredibly complex issue on Ind AS and IFRS, you can book a one-on-one consultation directly with CA Manish C. Iyer,
The director at GAAP Advisors, and the author of the thousands of responses we've discussed.
You can secure that consultation directly from his page on topmate.io.
It provides the opportunity to sit down virtually and forensically map out the architecture of your specific financial instruments with an expert who has stress-tested thousands of these exact scenarios.
Whether you are a CFO trying to structure a new supply chain finance facility without triggering a balance sheet expansion, or an audit partner trying to unravel a client's convoluted special purpose vehicle, booking that time on topmate.io provides the precision required to navigate the mechanics safely.
It just ensures that the economic substance of your transaction perfectly aligns with your legal and reporting obligations.
Well, we have meticulously dismantled a major financial illusion today. We started with a single sentence and a footnote about a surcharge on trade receivables.
And we followed the math all the way down to the bedrock of Ind AS 109 and Ind AS 32.
We've demonstrated how full recourse prevents the transfer of risk, how the resulting cash must be recognized as a liability, and how illegal offsetting mathematically manipulates the debt-to-equity ratios that investors rely on.
It really proves that financial statements must be read forensically, not passively.
I want to hand the floor to you for one final thought before we close. We spent an hour detailing the mathematical how and why of this specific error. But looking at the broader corporate ecosystem, what is the underlying takeaway an investor should walk away with after seeing a company execute this kind of balance sheet manipulation?
The crucial takeaway extends far beyond the technical violation of Ind AS 32. If a publicly listed company is willing to improperly offset assets and liabilities to artificially shrink its balance sheet and hide bank recourse on basic trade receivables, you have to ask yourself what that reveals about the integrity of their internal financial controls.
Right. Is it just a mistake?
Just exactly. Is an illegal netting of a 50 million rupee bank loan simply a technical oversight by an undertrained accounting department? Or does this highly specific, deliberate obfuscation serve as a massive red flag, masking a much larger systemic corporate liquidity crisis?
Wow.
If management is fighting this hard and bending the standards this severely to hide a collateralized loan from their investors, the ultimate question becomes, what else are they hiding in the footnotes?
That is exactly the forensic mindset that separates a victim of market manipulation from an empowered, analytical investor. An accounting anomaly is rarely isolated. It is almost always the visible fracture pointing to a deeper structural failure within the corporate entity.
Could have said it better.
We want to thank you, our audience, for investing your time and focus into this deep dive today. Your dedication to understanding the true mechanics of financial reporting is what ultimately forces transparency into the markets.
Truly, thank you for listening.
We have a few final requests as we wrap up. Please take a second right now to follow or subscribe to the Gap Advisors Ind AS Clinic podcasts. Whether you prefer to listen on Spotify, Amazon Music, or YouTube, hitting subscribe ensures you are at the table for every forensic breakdown we publish.
Furthermore, we strongly encourage you to follow the Gap Advisors Ind AS Clinic channel on WhatsApp.
It's so convenient.
It operates as a direct feed to your device, providing instant updates on all new videos, podcasts, the latest newsletter editions, newly published responses on the 4,500 issue repository, and critical alerts regarding new accounting standards as they are issued by the regulators.
It is the most efficient way to maintain a real-time pulse on the reporting landscape. Finally, if this episode clarified the mechanics of financial instruments for you, please share this podcast. Send it directly to your professional contacts, distribute it among your colleagues, and drop it into the communications channels for your audit and finance teams.
Most importantly, share this with students currently pursuing the CA course.
Yes, they are the future architects of our financial system, and spreading this rigorous, practical knowledge of Indian accounting standards is vital to equipping them for the realities of the market.
Absolutely.
Thank you again for joining the Gap Advisors Ind AS Clinic. Keep analyzing the footnotes, keep challenging the math, and we will see you on the next deep dive.